Let me ask you something. Why are so many people working hard every single day, yet very few end up rich? You see, we all start with the same goal. We all want financial freedom, comfort, and security. But something strange happens along the way. Some people climb the ladder and build real wealth, while most keep climbing but never reach the top. Why is that? Is it luck? Is it talent? Is it intelligence? I've spent more than 70 years studying money, business, and human behavior. And I can tell you the truth. It's none of those things. The real difference between the rich and the poor lies right here in the mind. The psychology of getting rich is more important than any degree, any job, or any amount of capital. Most people believe they make logical, smart financial decisions. But that's not true. The human brain wasn't built for the modern world of finance. It's ancient software running on modern hardware. Thousands of years ago, our ancestors needed fear and emotion to survive. But those same instincts that helped them avoid tigers now stop you from building wealth. You are still operating with the same fear, greed, envy, and impatience that ruled the caves, except now you're using them in the stock market, business, and life decisions. The first psychological trap that keeps people poor is fear of losing money. We call this loss aversion. Behavioral scientists have proven that losing $100 hurts twice as much as gaining $100 feels good. That means your brain hates losing more than it likes winning. So you make safe decisions, comfortable decisions, the kind that make you feel smart but keep you poor. You keep your money sitting in a saving account earning almost nothing because it feels safe. But inflation silently eats away your wealth every year. Right now, average inflation is around 3% annually. But many years it's higher. That means in 20 years your money loses half its value. People think they're avoiding risk, but they're actually guaranteeing loss. The rich think differently. They understand that not taking risk is itself risky. They focus on probability, not emotion. They ask, what's the expected outcome over time? If the odds are in their favor, they take the risk calmly, without fear. Warren Buffett and I have made billions, not because we are smarter, but because we can sit calmly while others panic. When the market falls, most people sell in fear. When everyone sells, we buy. Because the best time to buy is when people are afraid, and the best time to sell is when they are greedy. It's not about timing, it's about temperament. The next trap is herd behavior. Humans love to follow the crowd. Thousands of years ago, this kept you alive. If everyone was running, you ran too. In today's world, it keeps you broke. You see a friend making money in crypto or stocks, and you jump in. You buy because others are buying. Then prices fall, and you panic and sell. The crowd always moves at the wrong time. History repeats this again and again. The tulip mania in the 1600s, the dot-com bubble in the late 1990s, the housing crash in 2008. Every time people said, this time is different. It never is. The average investor underperforms the market because they chase what's popular instead of what's valuable. From 2002 to 2022, the S&P 500 returned about 9.5% per year on average. But the average investor earned only around 4%. Why? Because they bought high and sold low, following the crowd instead of thinking for themselves. The people who get rich learn to be comfortable being uncomfortable. They can hold a different opinion from the majority and stay calm. When the crowd is excited, they feel cautious. When the crowd is scared, they feel interested. It's not easy, but it's necessary. You can't outperform by copying everyone else. The third trap is what I call present bias, the desire for instant gratification. Most people prefer a small reward today over a bigger one tomorrow. They spend instead of saving because the pleasure of spending now is stronger than the idea of a rich future. But here's the math. If you invest just $500 a month at a 10% annual return, in 30 years you'll have over $1 million. That's not magic. That's compound interest, the most powerful force in finance. Albert Einstein called it the eighth wonder of the world. But your brain doesn't feel compound growth. It feels the dopamine hit from spending money now. The difference between rich and poor isn't intelligence. It's time preference. Rich people think in decades. Poor people think in weekends. The average American saves less than 5% of their income. The average millionaire saves more than 20%. That gap alone explains most of the difference. The rich delay pleasure. They invest first, spend later. The poor do the opposite, spend first, then try to save what's left. and there's never much left. Now, let's talk about confirmation bias, the tendency to believe what supports your existing views. Most people don't want the truth. They want to be right. They remember their winning decisions and forget the losing ones. They read news that agrees with them and ignore the rest. This keeps them stuck. In investing, it's deadly. If you buy a stock and it falls, you start reading articles about why it's still a great company. You convince yourself the market is wrong, but the market doesn't care what you believe. It only rewards accuracy, not ego. One of the things that Warren and I do is keep decision journals. We write down every major investment we make and why. Then years later, we go back and check where we right, where do we go wrong, what do we miss. That's how you get better. But most people don't want to face their own mistakes. They blame others, bad luck, or the market. That's how they stay poor, by refusing to learn. Another bias that hurts people is anchoring. Your brain latches onto the first number it sees and judges everything relative to it. You buy a stock at $100. It drops to $60 and you refuse to sell because you're waiting for it to get back to $100. But the price you paid is irrelevant. The only question that matters is, would you buy it today at $60 if you didn't already own it? If the answer is no, then you should sell. But people don't. They're anchored to the old price, which means they hold losers far too long. The same thing happens in real estate, cars, salaries, everywhere. Anchoring blinds you to reality. The rich avoid anchoring by doing independent analysis. They calculate intrinsic value. They ask, what is this truly worth? Not what was it worth yesterday. When you can see value clearly, you stop caring about price history. Then there's the sunk cost fallacy. The idea that you must continue because you've already invested time or money. People stay in bad jobs, failing businesses, or poor investments because they don't want to admit a loss. They say, I've already put in 5 years, or I've already invested $10,000. But that money and time are gone. There's sunk costs. The only question is what makes sense now. The rich are quick to cut losses and move on. They don't throw good money after bad. Overconfidence is another killer. Everyone thinks they're smarter than average. But that's impossible. Studies show that 90% of drivers think they're above average. Investors are no different. They believe they can predict the market. But the data says otherwise. Over a 20-year period, more than 80% of professional fund managers underperform the index. If professionals can't beat the market consistently, what makes you think you can? The rich understand this. They don't try to outguess the market. They buy great businesses at good prices and hold them long term. I've always said, it's better to be consistently not stupid than occasionally brilliant. You don't need to do extraordinary things to get rich. You just need to avoid ordinary mistakes. The problem is avoiding mistakes requires humility, and humility is rare. Most people would rather be clever than correct, but the world rewards results, not opinions. Now, let's talk about envy, the most foolish of all human emotions. Envy is the tax you pay for caring about other people's success. You see someone richer and you feel inadequate. So you start spending to keep up. New car, fancy phone, luxury vacation, not because you need them, but because someone else has them. This is why most people go broke trying to look rich. In the US, 60% of people making over $100,000 live paycheck to paycheck. Why? Because their lifestyle grows faster than their income. They're slaves to comparison. I've lived in the same house for 70 years. Not because I couldn't afford a bigger one, but because I didn't need it. Enough is the magic word. Once you define enough, you stop competing and start compounding. The happiest rich people I know aren't chasing more. They're chasing better. More time, more freedom, more purpose. Now, here's another trap. The love of story. Humans are storytelling animals. We need narratives to make sense of the world, but the stock market doesn't run on stories. It runs on math and psychology. Every day, financial news creates explanations for why the market went up or down. Stocks rose today due to optimism. Stocks fell today due to uncertainty. It's nonsense. The same data can justify any story. Rich investors ignore stories and focus on fundamentals. What is the company's cash flow, debt, competitive advantage, and management quality? Everything else is noise. The average investor checks prices every day. The rich investor checks value every year. The difference in behavior compounds massively. Imagine two people. One panics and trades every few weeks. The other calmly holds for decades. The second person will likely end up 10 times richer, not because they're smarter, but because they let compounding do the work. And that brings me to perhaps the most important lesson in the psychology of wealth systems over emotions. You can't rely on willpower to be rational. Your brain is emotional, impulsive, and lazy. You need systems to protect yourself from yourself. Let me give you a few. First, never make financial decisions in the heat of emotion. If an investment excites you too much or scares you too much, wait 24 hours before acting. Sleep on it. I've never regretted waiting, but I've often been grateful I did. Second, keep a decision journal. Write down what you're doing and why before you do it. Include your assumptions and what would prove you wrong. Later, review it. It's the fastest way to improve your thinking. Third, have a checklist before buying an investment. Ask, am I following the crowd? Am I acting out of fear or greed? Am I anchored to the past? Am I falling for a story? Am I ignoring risk? A checklist keeps you grounded when emotions rise. Fourth, say no often. Most opportunities aren't good. The world is full of noise. Default to no unless something is obviously excellent. Warren and I have missed hundreds of opportunities, but we've avoided thousands of mistakes. Fifth, seek disagreement. Find people who will tell you when you're wrong. Your brain naturally avoids criticism, but criticism is how you grow. If smart people disagree with you, don't argue. Listen. 6, learn from failure. Every mistake teaches you something, but only if you study it. Keep a record of what went wrong and why. Over time, you'll start to see patterns, your own psychological weak spots. Then you can fix them. The key to getting rich isn't knowing secrets. It's about thinking correctly, consistently, calmly, and rationally. You can't eliminate emotion, but you can learn to control it. You can't control the market, but you can control your behavior. Wealth flows to those who think long-term, who stay rational when others lose their heads, and who understand human psychology, their own and everyone else's. Remember, the market isn't made of numbers. It's made of people. People driven by fear, greed, envy, and ego. If you can stay logical while others lose their minds, the world will bring you wealth. Let me share some numbers with you. In 1950, $1 invested in the S&P 500 would be worth over $200 today, assuming reinvested dividends. That's the power of time. But to capture that return, you had to stay invested through wars, recessions, crashes, pandemics, all the events that made others panic. The average investor didn't get that $200. They jumped in and out following emotion. The psychology of getting rich is mostly the psychology of staying calm. Here's another fact. The top 10% of households in the United States own more than 85% of all stocks. It's not because they have special access. It's because they stay invested while others don't. Most people sell when it hurts most, when prices are low, and buy when it feels safe. When prices are high, the rich do the opposite. And it's not just about money. The same psychology applies to life. Discipline, patience, and rationality are useful everywhere. If you can delay gratification, if you can stay calm under pressure, if you can think independently, you will succeed in any field. Now, let me be honest, wealth will not solve all your problems. It will not make you wise or happy, but it will give you freedom. Freedom to choose to say no, to live on your own terms. That's what real wealth is. Money is just a tool. The real reward is independence of mind. In my life, I've learned that success isn't about brilliance. It's about avoiding stupidity. The world is full of bright people who self-destruct because they can't manage their own emotions. They drink too much, spend too much, gamble too much, or chase the wrong goals. Intelligence without discipline is like a Ferrari with no brakes. It looks fast until it crashes. If you want to build wealth, build character first. Be patient, be rational, and learn constantly. The world changes, but human nature doesn't. The same mistakes repeat century after century because people never change their psychology. You can't control others, but you can control yourself. The truth is, Money flows to the people who deserve it, not morally, but mentally. Those who think clearly, act consistently, and stay disciplined eventually attract opportunities, because most people can't do that for long. So here's my advice to you. Stop chasing quick money. Stop following the crowd. Stop comparing yourself to others. Start thinking in decades, not days. Build habits, not hopes. Study your own psychology and learn where you're weak. Build systems to protect yourself from yourself. Save regularly, invest consistently, and stay the course. The market will test your patience. People will test your emotions. The news will test your sanity. But if you can remain calm through all that, time will do the heavy lifting. You don't have to be a genius. You just have to be sensible. The psychology of getting rich is simple, but not easy. It's about resisting the emotions that control most people: fear, greed, envy, and patience. You can't eliminate them, but you can rise above them. Every great investor, every successful entrepreneur, every wise person has done exactly that. And I'll tell you one last thing. The biggest wealth lies not in your bank account, but in your mindset. Once you learn to think correctly about money, you'll never be poor again, because real wealth starts in the mind, not the wallet. Now go think better, act slower, and stay rational when the world goes mad. That's the real secret to getting rich, not just in money, but in life.